There are some massive changes coming to taxes that we just have to go over because Congress just dropped a 350-page proposal that could hit your wallet, your retirement plan, your business, and even your tips. And if this passes, the biggest winners and losers of the next 4 years may already be locked in, and chances are nobody's told you where you actually fall yet. Now, while we've all been focused on tariffs and who's made a deal with who, Congress has been cooking up their tax proposal, and this is the clearest sign yet of what the GOP wants the tax code to look like. And spoiler alert, it is loaded. Now, it's still just a draft, but the drafts are where the real DNA of the law starts to form. These are the pages where the loopholes are born and deductions quietly die. But get this, the bill's name is actually the One Big Beautiful Bill, which sounds like a beauty pageant entry more than a tax overhaul, but hey, it's branding that matters, right? You gotta love the name. So we've got to start with those Trump-era tax brackets that were set to expire in 2026 because they're now being made permanent, which in DC speak means that it's permanent until we change our minds again. Now, that higher standard deduction from 2017, that's also still in play, but get this, they're tossing in a bonus super deduction from 2025 through 2028. That'll be an extra $1,500 for single filers and an extra $1,000 for married couples. So once again, this is that marriage penalty at play. But it is temporary, of course, but why? Well, because it looks good now and disappears just in time for re-election season. I mean, can't you just see the campaign commercials already? Now, there will be some changes to the child tax credit. Now, it's going to stay at $2,000, but it's going to also be temporarily boosted to $2,500 from 2025 through 2028, and then it drops again. It's that way of saying, vote for us or watch your refund shrink. So just keep in mind, that's what we're going to see come re-election time next time around. Now, if you're a business owner, that 20% qualified business income deduction that was set to go away, it's not only staying and becoming permanent, it's also climbing to 23%, and it's going to phase out more slowly. So real estate investors, small business owners, this is a very nice win, so long as you know how to claim it correctly. Now, we've talked about keeping more of what you earn, but now let's talk about keeping more of what you leave, because the estate exemption jumps to $15 million in 2026, and it's going to be indexed for inflation moving forward. So it's not a full repeal, it's just a higher ceiling so the government can still pretend that they're taxing the rich. Now, if legacy planning is part of your playbook, then the runway just got longer, so you want to take advantage of it. Now, with every give, there's a little take, and in this case, it's AMT and the fact that it's still alive. It is the zombie of the tax code that's just never going to die. As for other itemized deductions, they remain capped and complex. For example, mortgage interest deduction, still capped at $750,000. Casualty loss, well, you still need a federal disaster declaration, meaning that if your kitchen floods but FEMA doesn't show up, then the IRS still expects you to suck it up. Now, there is some drama around the SALT cap, which is proposed to be raised to $30,000 or $15,000 if you're separately filing, but there's a catch. See, if you make more than $400,000 or $200,000 separately, then the cap is going to melt away at 20% of every extra dollar until you're back at the old cap. So the translation here is the more successful you are, the less you can deduct. And that marriage penalty, well, it's alive and well, and in fact, it's stronger than ever. Now, before we keep going, what do you think about these potential changes, and what would you like to see in the final version of the bill? Drop it in the comments below, because I'd love to see what you hope for in the new tax law. Now, the next proposed change was a campaign trail promise, which was no tax on tips, and we got that, sort of, because tips become tax deductible, but only if you're in a traditional tipping role. So if you're a doctor thinking about turning around that iPad at checkout asking for a tip, that's just not going to work. But there's so much ambiguity here that it just feels like there's got to be more clarity here, because someone's going to try to game this. And so hopefully in the new tax law, there's a little bit more clarity into what this actually means. There's also going to be no tax on overtime pay. And this overtime pay is going to become deductible, but only if you're not a high earner. So it's a tax break with a glass ceiling. So work harder, but just not too hard. And then we get a bonus for seniors. You see, seniors 65 and older get an extra $4,000 deduction, but once again, only from 2025 through 2028. But if you earn over $150,000 or $75,000 if you're single, well, say goodbye to that extra deduction. Now, there was a lot of discussion around Social Security not being taxed, and it seems like this might have been the workaround because that was not included in the draft bill. Now, there was a surprise in the proposed bill, and that was a proposed deduction for interest on auto loans for vehicles that were purchased after 2024. And it was up to $10,000 a year that would be deductible, but it has to be on a US assembled car. Now, it applies to motorcycles, ATVs, campers, so your weekend toy might actually be tax friendly, but of course it's phased out at $200,000 or $100,000 if you're single. Now, charitable giving also gets a nod here too, because that small above the line deduction for charitable giving is back for $300 for couples and $150 for singles, which is better than nothing, right? Now, think of this as Congress just patting you on the head for being a good person. But then we get to something really interesting, the MAGA accounts. And I'm not making this up, they're actually called MAGA accounts, Money Account for Growth and Advancement. So it's like a 529 plan, but with stricter rules, and you gotta have the name. So it's a $5,000 max contribution per year. It's tax-free for education, home buying, or small businesses. And if you withdraw early or incorrectly, we'll get ready for a bunch of penalties. Now the bonus here is if you have a kid between 2025 and 2028, well, the government's gonna drop $1,000 into the account. So it's kind of like a baby bonus with strings attached. I just wish that for my 7 and 8-year-old, they'd throw a couple $1,000s in the pot for me because, hey, kids are expensive, right? Now, there are some potential rule changes for HSAs. For example, Medicare Part A is no longer going to be a barrier to contributing. And get this, gym memberships will now be a qualified medical expense. That's right, fitness is now officially part of financial planning. It'll be $1,000 for a couple or $500 single. On top of that, spouses will be able to make catch-up contributions into the same HSA, and you'll even be able to deduct expenses from before you open the HSA as long as you open the account within 60 days. So it feels like a fine print trap, but it's a nice little benefit. Now the next proposed change is around bonus depreciation, which is back. You get 100% write-offs returns for 5 to 6 years, which is a major win for real estate professionals and capital-intensive businesses. Now, opportunity zones, they also get a second win because new investments between 2027 and 2033 get a huge basis step up to 30% if invested in qualified rural opportunity funds. But if you invest now, you miss out. So this is weirdly the benefit comes if you procrastinate type of change. And then there's some potential flexibility coming to 529 plans, which will now work for K through 12, homeschool, and credential programs. Even employer-paid student loans will be permanently tax-free, and that $5,250 limit becomes permanent and inflation adjusted. So slowly but surely, the education tax code is catching up with reality. Now, there's a new credit for scholarship donors. So if you give to a scholarship organization, you get a tax credit up to $5,000 or $10,000 of your adjusted gross income. It's not refundable, but can be carried forward for 5 years. So it'll be important to plan ahead. Now, there's a lot to unpack in this bill. I mean, it was hundreds of pages. But there's a few things that we're missing, and the biggest one that stood out was that there was no Social Security tax reform. And I know that's shocking, and if you've been following our channel for a while, you know that I've always said I don't believe Social Security is going bankrupt, but it's something that's going to just get kicked down the road for quite some time. There's also no change to step up in basis, which was a big concern for a while that it was going to go away, so this is a huge win for legacy planning. And then there was no changes to retirement accounts. So there's some things that I think will likely be coming, but they're just not in this proposed bill. This draft bill is packed with targeted giveaways, phased incentives, and temporary boosts designed to look good now and create pressure later on. It's phased, delayed, and temporary. You know, the 3 horsemen of Washington tax policy. Now the Senate's going to remix this, there are markups coming, and none of this is law yet. But if you wait until it is, then you've already lost your planning window. So what do you think? What potential changes do you want to see, and what do you think you're going to see in the final bill? Now make sure you subscribe because this is just the first of the changes that are likely coming, and we're going to break them all down every single time that we get an announcement like this. Until then, I'll see you next time.